Special report from ABC News Digital.
I'm Dan Pfeffler in New York with this ABC News Digital Special Report. Ben Bernanke up there celebrating the 100-year anniversary of the Fed. And with him, past Fed chairs, Alan Greenspan, Paul Volcker, and you can see the upcoming changing of the guard, Janet Yellen sitting beside as well. Wall Street watching that meeting today to see if the current chair, Bernanke, will give any hints of tapering. Today, though, likely to be more ceremony than substance. The big day is this Wednesday, but still a significant day today. And so joining me now to discuss some of the points about today and also for the coming days, Joe Doe, economics analyst for The Street. Joe, thanks for being with us today. We appreciate it. We're going to go back and forth between as Bernanke will be making his way up to make some comments in just a minute. But first, I just want to kind of go over, catch everyone up right now. Bernanke had a 7-year run leading the central bank. He's now got the option of beginning the end, essentially, of that unconventional asset purchase program, popularly called quantitative easing. And now the Federal Open Market Committee will be holding its 2-day meeting on Wednesday. Joe, I'm going to get to you in just a minute. But first, the current Fed chair, Ben Bernanke, at the podium.
Well, Paul and Alan have me at a disadvantage. We were each asked to reflect on our term in office, but they have a little bit more perspective than I do at this point, as I have a few more weeks to go, and a number of tasks that we undertook, such as achieving a full recovery in the U.S. economy, are still ongoing. But I will offer a few thoughts about the last 8 years. The Federal Reserve's extraordinary response to the financial crisis and the Great Recession was, in some ways, nothing new. We did what central banks have done for many years and what they were created to do. We served as a source of liquidity and stability in the financial markets and in the broader economy, and we worked to foster economic recovery and price stability. However, in another sense, what we did was very new. It was unprecedented in both scale and scope, and it made use of a number of tools that were new or at least not part of the conventional central bank toolkit. We found that these new tools were necessary if we were to fulfill the classic functions of a central bank in the context of a 21st century economic and financial environment. When the financial system teetered near collapse in 2008 and 2009, we responded as the 19th century essayist Walter Bagehot had advised, by serving as liquidity provider of last resort to financial firms and markets. But we did so in an institutional environment that was very different and in many ways much more complex than the one that Bagehot knew. For example, the recent crisis involved runs on financial institutions, as occurred in classic panics. But in 2008, rather than a run of retail bank depositors, the run occurred in various forms of short-term, uninsured wholesale funding, such as commercial paper and repurchase agreements. Moreover, although commercial banks suffered large losses and some came under significant pressure, the crisis hit particularly hard those non-bank institutions most dependent on wholesale funding, such as investment banks and securitization vehicles. Thus, the Fed lent not only to commercial banks, but also extended its liquidity facilities to critical non-bank institutions and key financial institutions in markets like the commercial paper market. To minimize the risk of strains abroad feeding back to U.S. dollar funding markets, the Fed also coordinated with foreign central banks to create a network of currency swap lines. Beyond the provision of liquidity, the Fed worked with other agencies, both here and abroad, to help restore public confidence in the financial system. Notably, we led the development of stress testing of large banking organizations' capital adequacy. The first stress tests in 2009 and the public disclosure of the results made it possible for large U.S. banks to once again attract private capital. Since 2009, the stress tests and disclosures, together with other regulatory and supervisory actions, have contributed to a doubling in capital held by the largest U.S. financial institutions and the resumption of more normal flows of credit. The Fed has also worked to draw upon the lessons of the crisis and to take the steps necessary to avoid a similar event in the future. As those assembled here well know, the deliberations that led to the founding of the Federal Reserve were precipitated by a financial panic, the Panic of 1907. The preservation of financial stability was consequently a principal goal of the creators of the new central bank. In response to the panic of 2008, the Federal Reserve has returned to its roots by restoring financial stability as a central objective alongside the traditional goals of monetary policy. We have refocused our supervision of financial institutions to take a more macroprudential approach that fosters systemic stability as well as the stability of individual institutions. We also more extensively monitor the financial system as a whole, and in cooperation with other agencies, have put in place stronger oversight of systemically important financial firms, including higher capital and liquidity requirements, tougher supervision, and processes for orderly resolution. We've also had to be innovative in finding ways to use monetary policy to help the economy recover from the deep recession that followed the crisis. Providing adequate monetary accommodation has not been a straightforward task because our principal monetary policy tool, the target for the federal funds rate, has been stuck near zero since the end of 2008. Consequently, we've had to find other ways to bring monetary policy to bear, notably including techniques designed to influence longer-term interest rates. For instance, the Fed, like several other central banks, has purchased longer-term securities to put downward pressure on longer-term interest rates, help ease financial conditions, and to promote a stronger recovery. A significant aspect of finding innovative ways to execute our duties as a central bank in a new, more complex environment has been the ongoing revolution in communication and transparency. Part of that effort has involved formally defining our goals under the mandate for maximum employment and price stability given to us by the Congress. 2 years ago, we established 2% as our inflation goal, and we regularly communicate policymakers' views of the level of unemployment expected to correspond to maximum sustainable employment over time. Additionally, our monetary policy has come to rely more heavily on forward guidance. With our short-term policy rate about as low as it can go, we have sought to ease financial conditions further and provide additional impetus by communicating both quantitatively about the likely future path of policy and qualitatively about the likely evolution of our balance sheet. Other central banks around the world have met the challenge of current conditions with similar innovations. And I would be remiss if I did not point out, especially with Paul and Alan here, that the Fed's recent communications innovations owe a great deal to developments like the monetary targeting framework devised under Chairman Volcker and the post-FOMC statement and qualitative forward guidance introduced under Chairman Greenspan. In summary, the financial crisis that the Fed confronted 5 years ago was in many ways analogous to the panics that central banks have faced for centuries. But at the same time, the crisis and the deep recession that followed occurred in an economic and financial environment that was certainly different and in many ways more complex than in the past. The Federal Reserve found ways to carry out its traditional central bank functions in that environment, and we are working with other policymakers domestically and internationally to put in place a strengthened regulatory framework that will help preserve stability in the face of the complexity, interconnectedness, and innovation of a modern financial system. One of my personal objectives since I became chairman has been to increase the transparency of the Fed, to more clearly explain how our policies are intended to work and the thinking behind our decisions. As I already noted, improved communication can help our policies work better, whether through the disclosure of bank stress test results or by helping the public and the market better understand how monetary policy is likely to evolve. Ultimately, however, the most important reason for transparency and clear communication is to help ensure the accountability of our independent institution to the American people and their elected representatives. Clarity, transparency, and accountability help build public confidence in the Federal Reserve, which is essential if it's to be successful in fostering stability and prosperity. Thanks for inviting me to this wonderful event. Thank you.
Joe Doe at the street. The market's up 150 points. What are we reading into that? Did Bernanke say anything to indicate about what he might be doing in the following weeks?
Marking the Centennial Now, right now, the Federal Reserve bankers on the FOMC, including Ben Bernanke, are in a blackout period, and so right now they're not giving any sort of economic information to the market until Wednesday. What we got to hear from Ben Bernanke today and from the other chairman was basically what they've been doing since Volcker came in the 1970s, and what they've handled in some of the innovations they've brought to the central bank, which now is turning 100 years old this year.
And so as we're waiting now for Janet Yellen, expected incoming Fed chair, as we're waiting for her to take to the podium, I wanted to ask you about this. Wall Street Journal poll found that about a quarter of the economists that were polled, they expect a taper announcement on Wednesday. That has been somewhat higher of a confidence level that there's going to be a significant announcement made.
Absolutely. A number of the different analysts and economists I've been talking to over the past couple weeks have grown in number who think that we might actually get a taper announcement in December, and that's because of the load of good economic news we've been seeing. Manufacturing activity, labor data, and housing information has been pretty solid. And so this gives a number of economists reason to believe that the Fed might try out something in terms of pulling back on quantitative easing, likely in the longer-term treasuries. But I am still hearing probably more people, more economists, more people in the know who are saying we're looking at that March announcement to be when we really see a pullback by the Fed. But I would not be surprised at this point if we do hear something on Wednesday.
Let's take a walk through history, if we can, because as we saw, as that ceremony was marking 100 years for the Federal Reserve, three powerful leaders of the Fed all gathered together today: Alan Greenspan, Paul Volcker, Ben Bernanke. How has the Fed policy impacted the economy over the years? As far as if you look at 2008 and then going further back to the years of Paul Volcker when he was first appointed by Jimmy Carter.
Well, starting with 2008, the Bernanke period, it's hard to say that that the Fed has not affected the economy in every way. I mean, a lot of arguments against Federal Reserve quantitative easing is that the markets have fundamentally moved up and down based on the latest forecast, the latest information coming out from Ben Bernanke and other central bankers. I mean, every time a Fed president of a different Federal Reserve bank comes and speaks, oftentimes it moves the market. When you move back to Volcker, I mean, Volcker came in at a time of high inflation. He came in and immediately says, we really have to bring this inflation down. Initial moves by Volcker were not that successful, but eventually they were able to rein in the inflation problems, which brought in, of course, following that, Alan Greenspan. Alan Greenspan had a great time of economic growth here in the United States of America, though his critics do point out that he kept rates probably too low throughout his time, considering that there was so much growth in this economy.
Now, markets have had an incredible run this past year, up more than 20%, in fact, year to date. And we're taking a look at how the Dow is reacting right there, up about 150 points, just short of at 15,904. Skeptics, though, are saying that because the Fed has been pumping money into the economy, $85 billion a month there, that it is essentially it's a sugar high, that it's an artificial, it's a hyped economy.
Right. Well, critics have been pointing that out, and there has been a lot of discussion in recent weeks and maybe even months that, hey, is there a stock market bubble? When you look to the price-earnings ratio on the S&P, about a healthy level is about 15. Right now we're looking at just about 17, which a number of analysts, chief investment officers are saying that really doesn't suggest a bubble economy. But yeah, we certainly have seen stocks rise quite a bit. I mean, 25% this year in the S&P. And a large argument for it is that with the Fed using their monetary stimulus program, it gives stocks a little bit of a cushion there. But a lot of people I'm talking to who are expecting a taper next year in 2014 are saying when we do get the taper, right, not if, but when we get the taper next year, we're not going to see the S&P pull back into kind of a recession. We might get a 3-4% drop, but that's only to be expected. And they're not too worried about a drop like that, especially seeing stocks rise the way that they have this year.
Play that out then. What's going to happen to someone's 401k and retirement plans?
I think in general, when you're talking to investment managers who are dealing more with retirement, they're saying that, and this is not, the worst time was probably in 2008, 2009, really when the whole economy was losing money, we were losing jobs. Now you can look and see that there is a bit of stability in the economy. And what does that mean? Well, it means we're seeing more hiring. We are seeing that unemployment rate dip, and the most recent report said we're not only seeing the unemployment rate dip, but we're seeing participation rate go higher, which means that more of those part-time workers are coming on to full-time, it suggests that for people with a regular 401k, maybe there isn't so much to worry about right now, maybe not the way that they were worrying in 2008, 2009 during the height of the recession. Does this mean we're suddenly back in 1995-96 in terms of economic growth? No, certainly not. But most of the economists and analysts that I've been talking to seem pretty confident right now. They're not overly confident. It doesn't seem like a market that's getting out in front of itself.
Let me ask you this then, going forward then, as far as like any kind of a policy change, going from Ben Bernanke to incoming expected chair Janet Yellen, she's been widely seen as someone who will take the Fed in a more progressive direction. What are we hearing then as far as the agenda, the variation that she might have from Bernanke?
So I think a little bit of the worry initially had been that Janet Yellen would be far more dovish. In other words, that she would be more open to monetary stimulus, more economic stimulus than Ben Bernanke. But what it seems at this point is that Yellen is well known for her communication skills, and she's also pretty good at explaining in layman's terms monetary policy. So I think what a lot of people are expecting is that Yellen's going to come in, she's going to have to be the person that really begins this large scaling back of asset purchases by the Federal Reserve. She will be the person who brings the Federal Reserve out of this unprecedented period. And so what should we expect for her? She won't be as dovish as people are arguing, I don't think. I mean, inherently, by pulling back on quantitative easing, that's not a very dovish move. She's going to want to keep an eye on inflation, of course. You know, a lot of people are saying we're not seeing inflation now, but it could be a longer term issue. And then I think she's really going to continue to focus on that unemployment projection by the Federal Reserve. They've been talking 6.5% unemployment at a point at which they would consider raising the federal funds rate, raising interest rates. It's really going to be an interesting time. The Yellen period is going to be totally different from the Bernanke period, the way that Bernanke was totally different from Greenspan and further back.
And so we shall wait to see how that will play out in the coming weeks, the beginning of 2014. Joe Doe from the street. Joe, thank you for your time, your inside analysis. Invaluable. Thank you so much. And of course, that news conference, that ceremony will continue live streaming right here on abcnews.com, and we have a complete report as well. For now, I'm Dan Kleffler in New York with this ABC News Digital Special Report.